Welcome to today's market report.
US stocks fell on Wednesday and two-year Treasury yields clung to 18-month highs after data showed inflation ran faster than expected in September, cementing bets that a policy tightening by the Federal Reserve is in the offing. Figures show the US Consumer Price Index rose 0.4% last month, higher than an expected 0.3% as Americans paid more for food, rent, and a range of other goods, and highlighting the challenges of strained supply chains. Persistent inflation suggests we remain in a hot economy, which could prompt the Fed to move sooner, analysts from Bank of America said. Concerns that an end to the Fed's ultra-loose monetary conditions would undercut support for equities dragged on US shares despite gains in technology stocks and an encouraging earnings report from JP Morgan. The latest US bank reported third-quarter earnings on Wednesday that beat estimates thanks to record revenue in some investment banking business and a sunnier economic outlook that allowed it to release money set aside for potential loan losses. JP Morgan stock was down 2.4% by midday. The Dow Jones fell 0.25%, the S&P 500 edged down 0.02%, while the Nasdaq added 0.37%. The Pan-European Stock 600 index rose 0.7%, and the MSCI schedule stocks across the globe gained 0.3%. The two-year Treasury yield jumped as high as to 0.394%, a level last seen since March 2020, before receding to 0.36%. Benchmark 10-year yields declined to 1.5525% from 1.58% late on Tuesday. That left the spread between 10-year and 2-year Treasury yields at around 118 basis points, the lowest in over 2 weeks. The dollar, which has benefited from bets that tighter US monetary policy would burnish its appeal as a higher-yielding currency, took a breather on Wednesday. The dollar index fell 0.42% to 94.126 from a one-year high of 94.563 struck the previous day. The softer dollar helped the euro to jump 0.45% of near 15-month low to 1.1581. The Japanese yen, which has hovered at a 3-year low against the dollar, also bounced back, rising 0.18% to 113.38 per dollar. Oil prices, which have been on a tear, also paused their rally as some investors questioned whether inflation and other supply chain issues will crimp economic growth and ultimately energy demand. However, analysts at JP Morgan argued on Wednesday that concerns of accelerating inflation, retarding economic growth, and resulting in stagflation were overblown. Historically, equity markets did well in periods of oil prices increase, particularly those periods that follows a crisis. The analysts said they recommended that investors allocate more cash to shares in the energy, materials, industrial, and financial sectors relative to other investors. US crude fell 0.14% to $80.53 per barrel. Brent was at 83.24, down 0.22% on the day. Gold, usually seen as a hedge against inflation, shone. Spot gold added 1.9% to $1,793.97 per ounce. US gold futures gained 1.98% to $1,793.10 per ounce. The British pound advances almost half-cent, trading at 136.51. The market sentiment is mixed as US equity indices seesaw between gains and losses. Higher US inflation September reading than estimated, coupled with slower growth, threatens to derail the economic recovery. Furthermore, an ongoing energy crunch in Asia and Europe spurred the perception in consumers that companies with higher electricity prices could pass on those costs onto them without harming the business. The UK economic docket featured the gross domestic product for August annually, which rose by 6.9%, 2 ticks higher than the 6.7% estimated by economists. Despite being a positive figure, investors' focus was on the US Consumer Price Index. The GBP/USD barely blinked on the news. Meanwhile, the US CPI rose by 5.4% more than expected, and reading is the highest annual gain since 2008. The core CPI exclude food and energy increased by 4% annually, according to estimation. The GBP/USD initial reaction was to the downside, reaching 135.87, but bounced off the lows soon after. The euro extends recovery from 115.25 lows to levels near 116, with investors awaiting FOMC meeting.
This is today's market news. Thanks for listening. We'll see you next time.